discounted cash flow analysis is on Apple. So the first thing that I've done is, in the first assignment, I have analyzed the 3 financial statements of Apple thoroughly. And in the second assignment, I have done a relative valuation by comparing Apple to a couple of other companies within the same sector in America. So this is the third part of my entire analysis, which will analyze the intrinsic value of Apple. So in a DCF analysis, there's basically 2 parts. The first part is the projection period in the near future, which means either the next 5 years or 10 years. So I have chosen 10 years. And the second part is calculating the terminal value in the distant future. So step 1 in a discounted cash flow analysis is to project future unlevered free cash flow, so which is also called free cash flow to firm. This is what I have done. So I've projected the revenue for the next 10 years. As you can see, these figures are all taken from the financial statements, which can be found on the 10K report, either on investors' website of Apple or on the SEC website. Yes, so this is my projection. What I need to start off with is my assumptions, basically, and why I've taken those assumptions. So in order to project these figures, such as revenue for the next 10 years and EBITDA and changes in capex and working capital, I need to have a couple of assumptions. So here I have taken a growth rate of 14. I was really doubting whether this is a sensible figure or not. However, I've checked my comparable companies analysis, and I've also checked some other analysts what their opinion is on the growth rate. So for example, on Yahoo Finance, I found a growth rate of 16%. So this is why I've taken 14%. So usually you can take the growth rate by the average of the past 5 to 10 years. But with Apple, I assume that the most probable likely scenario will be that it's going to be a lower growth rate. But this is just too much analysis that I would have to do to say why I think it's going to be lower, so I want to keep it short. Okay, so then the next thing, the EBITDA margin assumption. I've taken 30%. This is actually on macro trends. It was a similar number. It's not exactly the same. The same thing, you can take the average of the EBITDA margins of, I've taken the past 3 years, the average of it, and also in my comparable companies analysis, which I've got here, I can show that. I have a EBITDA margin of, where is it? There we go, 32% here, 32%. So it is quite similar. I have just taken a little bit lower, which is 30%. Taxes, corporation tax in the US is 31%, thanks to Trump. And yeah, the capex growth rate, I've taken 5%. Again, why I've taken 5% is because I've just taken the average of the last 3 years. EBITDA multiple, 23%. Again, this is up to an analyst's opinion or calculation. According to my analysis, I thought 23% is reasonable because my relative analysis has got a figure of 23. EBITDA multiple 23. So I thought 23 is reasonable, and I've also checked online with other analysts what they're thinking. So it's pretty much similar. So 23 is a reasonable figure. And then same thing, the average for the changes in net working capital. I've just taken the average of the last 3 years and then applied it. But the problem, as we know in any DCF analysis, is the assumptions. So any change of the assumptions, any slight change could just bring us to a completely deviating enterprise value. This is why I've just later applied a sensitivity analysis just to see what would happen if certain figures change, such as the discount factor or the EBITDA multiple, or what would happen if the growth rate changes, what kind of enterprise value would we get. I should have taken less values here because this is not that realistic. A growth rate of 18% is quite high. I don't think Apple is at the stage where this could be realistic, because it's just they have to come up with a really good ideas, innovative product. So I think I should have gone slightly down with the estimations for the growth rates. Right, the next thing is after I've projected the cash flows for the free cash flows for the next 10 years, I calculated the discount rate. So this is a little bit it took me a little bit long because I had to decide and check what the discount rate would be. So I've just done a separate sheet on Excel for that. So the discount rate is, as we know, the weighted average cost of capital. Here I had to figure out, in order to calculate the WACC, I had to figure out what the cost of equity is, and for that I used the capital asset pricing model. And for this I took the yield for the 10-year US treasuries, and this is just available pretty much everywhere. I've just taken the official figure on treasuries on the US Treasuries government website, which is currently 1.78 for 10 years government bonds. The expected return of market, I took 10%, and this is because I took the average of the annual return from the S&P 500, and also different sources have pretty much similar figure. And then the beta, this is from Yahoo Finance, for Apple was 1.2. So once I had this, I was able to calculate WACC, and for the figures where I've taken them from, pretty much this was just the market cap of Apple, and then the market value of debt. This you can see that for any company on its 10K filing under total term debt. For the cost of debt, I took 3%. This is also an estimation. I've just looked at the interest rates that Apple was paying between the years of 2013 and 2020. So I thought, okay, I'll just take the average, and I took 3%. And then, so Excel did pretty much the rest for me. So this is just the formula we learned at our lessons, and I've just applied it on Excel, and then I was able to calculate the WACC, the discount factor. So once I knew this, I put it back on my DCF sheet, and I applied it here, discount factor, with the formula that we learned, and discounted the future cash flows to their present cash flow. Right, so here we can see this is the present value of the unlevered free cash flows of Apple. And yeah, so here we can see it's increasing. Right, so then the next step after I calculated the discount rate was to get to the second part. Sorry, I just forgot one step, which is I discounted the free cash flows and summed up the net present value. But this is a very easy step, so all you do is so I just did basically, I added up the free cash flows of the present value, and this was the figure I got, which is 2.1 trillion. Right, we are not done yet, because this is all the calculations for the present value of the future cash flows of the next 10 years. Now, the second part of a DCF analysis consists of the terminal value, which is basically the distant future. And for that, what I did is that I used the EBITDA multiple of 23, which I estimated in my relative valuation, and I've applied that. So as you can see, the terminal value is just by multiplying the EBITDA by the EBITDA exit number, and we would get a terminal value. But we're not finished here, because we have to discount that to the present value. Here we've used the discount factor, and I got the present value of the terminal value. And as a last step, I just added those two up, the present value of the free cash flows for the next 10 years, and the present value of the terminal value, which gave me an enterprise value of 5.8. Right, so I was not happy with that because I just didn't know. I had too many thoughts in my head. I was like, okay, what would happen if we had a different discount rate? What would happen if we had a different exit multiple? What if we had different revenue growth rates? So I just had too many questions in my head, and I didn't know if this is justifiable or if this is a good number. So this is why I've applied a sensitivity analysis, just to see with different exit multiples and discount rates and revenue growth rates, what kind of enterprise value I would have gotten if they changed. And this is the range of all the values I got at the end, because I thought, okay, if these factors change, then the enterprise value of Apple would be this, or this. So I think as a conclusion, I can say what I learned is that in discounted cash flow analysis, you can never find a single value and say this is the intrinsic value of this company. It is just a range of different values, and from there you can estimate what the value is. That's why it's always good to use multiple analysis in combination. For example, here, this is my relative valuation. I have a complete different figure, which is not complete different, but an estimation of Apple's enterprise value. This is $2.8 trillion. Yeah, and this will just give you an idea of what Apple's value could be. maybe just very quickly to my relative valuation analysis here. This is a very, I wouldn't say short, but I've only compared Apple against 5 different companies. So in an ideal scenario, the best way is to have many companies, maybe up to 10, that you can compare your target company against. But the problem with that is that you have to really find companies with the same capital structure, within the same geographical region, with the same business profile, same business operations, same size, same profitability, in order to really have a fair, comparable company, basically. So this is not impossible, but you just have to bear in mind it's all an estimation, right? So here I've just taken 5 companies from America within the same, who operate in the same sector, who are also classified as technology companies, and I've taken their figures from their financial statements and made estimations of their revenue, EBITDA, net income for the next 2 years, and then I projected their revenue growth and EBITDA growth, and from that I calculated their enterprise value to EBITDA, for example, here for the next 2 years and for the trailing 12 months, and their PE multiples as well. So here, for example, we can see Apple's PE ratio is 31.5%, right? And the median of those 5 companies is almost 29 of their earnings per share for their price. Okay, so this for me means that it is overvalued because it is above the median. The PE ratio of those 5 companies is almost 29, and Apple is just above it. Same for the enterprise to EBITDA multiple. The ratio is 23 for Apple, and the median of those 5 companies is 18. Again, Apple is overvalued here, and yeah, as I said, this is 5 companies. I don't think is enough to make a whole judgment. So even though it looks like it's overvalued, it's the analysis itself is not enough to just say it's overvalued and it's not a good idea to invest. Of course, you also have to bear in mind that there is different strategies in investing. So from a value investor perspective, Apple would probably not be the best pick, but from another perspective or an investor who's got a different strategy, you could invest in it. So it's really up to the investor what kind of strategy they're using, what is it that they're looking at, and there's so many factors that has to be kept in mind in order to come to a conclusion. Yes, so this was my discounted cash flow analysis for Apple. And if you've got any questions or anything that's not clear and why I use certain assumptions, please let me know. Or any questions in general, how I concluded the numbers, please let me know. You can contact me via my email. Most of you have got my number as well. Or you can leave a comment on YouTube and I will get back to you. Thank you very much.